Hey everyone, welcome back once again to our CA Foundation Business Economic Quick Series where we are discussing CA Foundation Business Economic topics in a quick and practical manner. So without wasting much time, let's get back to the video. So we are covering chapter 4 price determination in various market, in which we are today covering unit 3, which is price output determination in different market structures. So understanding, here is the introduction. Understanding how prices and output are determined in various market structure is crucial for analyzing business decisions and market outcomes. So first comes perfect competition. That its example could be agriculture market where numerous farmers sell identical crops like wheat or rice. Features of perfect competition would could be first one, there are large number of buyers and sellers, so no single buyer or seller can influence the market price. Everyone is price taker, means they have to accept the price which is available or going in the market. Second feature is homogeneous product, that is product offered by different firms are identical, leading to no brand loyalty, so the product will be same. Third, there is free entry and exit, that is firms can freely enter or exit the market, ensuring no long term abnormal profits. Fourth, perfect information, that means buyers and sellers have full knowledge of price, technology and market condition. And fifth, no transportation cost. Here it is assumed that there are no transportation cost, which helps keep the price uniform. Then comes equilibrium of the industry, that is in perfect competition the industry equilibrium is achieved when the total quantity supplied by all the firms equals to the total quantity demanded by all consumers. The price at which this balance occurs is the equilibrium price. Then comes equilibrium of the firm, that is a firm is perfect competition, in perfect competition maximizes profit where its marginal cost, that is additional cost, equals to marginal revenue, which is also equal to the market price. So we have a tabular example for it. So I have example short run profit maximization in perfect competition. We have outputs, that is 10 quantity, 20, 30, 40, and we have the same price for all the quantities, while the total cost will be difference in every case. The marginal cost is also changing and increasing. Similarly, there is a column for total revenue and then marginal revenue, and lastly a column for profit. So in the case 3, where our output is 30, the price will be rupees 100 and the total cost is 2500, and marginal means the additional cost for the from 20 to 30, the additional cost is 90. Here marginal level is nearby same, that is 100, where the profit will be maximum, that is 500 in our case. So exactly we don't have marginal cost equals to marginal revenue, but it's nearby, because you can see in the next case the marginal cost is 130 above, more than the marginal revenue. So this is the ideal scenario, where our units are 30 and marginal cost is equal to marginal revenue and the profit would be maximum. So here the firm maximizes profit at 30 units of output where marginal cost equals to marginal revenue, and that's equal to price, that is rupees 100. So beyond this output the cost starts to outweigh the revenue, leading to a diminishing profit. So after that the profit will be on the lower side. Then comes long run equilibrium. So in the long run, firms in the perfect competitive market will earn only normal profit, because new firm will enter the market if there are super normal profits, and firms will exit if there are losses, driving the price to the point where price is equal to etc. Then comes second one, that is monopoly. Example is best example is Indian Railway for passenger services being the sole provider. So currently there are also cases where government is trying to privatize it for some part, but for our example we can consider is a best example for monopoly. So the features could be: first, there is single seller. The firm is the only producer in the market, and thus is it is the price maker. So it will decide the price. Second, no close substitute. That means the product offered has no close substitutes, giving the firm significant market power. So they are powerful because they are a price maker. Third, high barriers to entry. So significant obstacles prevents other firms from entering the market, such as patents, control over resources, or government regulation. So there are a high entry barriers, so no one can easily enter the market. Fourth one, price discrimination. That is, a monopolistic can charge different price for the same product based on the consumer's willingness to pay. So they can charge a different price for different scenarios or for different consumers, and since they are the price maker, that will be more beneficial for them. Now comes how monopolies arise. So monopolies can arise due to various factors such as government regulations, in our case Indian Railways, ownership of key resources. Some key crucial resources are owned by a specific organization or entity. Third, economies of scale or technological superiority. So we have some tech advancement, or we have production line, such efficient production line, so that we can produce on a large scale. Now comes monopolistic revenue curve. So unlike in perfect competition, the monopolistic marginal revenue, that's MR curve, lies below the demand curve, because to sell more units, the monopolistic must lower the price for each additional unit. So the marginal cost should be lower in order to get maximum profit. So here are four cases similar to earlier one. We have output in units, price, total revenue, total cost, marginal revenue, marginal cost, and profit. So you can see in the second case, where our units are 15, the price is 90 and total revenue is 1350, while the total cost is 750. So we have marginal revenue is calculated by marginal revenue is nothing but the difference between the two change units. So it is calculated as above: 1350 minus 1000 divided by the difference between these two stages, that is 5 units. So we get 70, while the marginal cost is 50 and we have maximum profit of 600. So here the monopolistic maximizes profit by producing 15 units where marginal revenue equals to marginal cost. So marginal revenue is nearby, means equal to marginal cost, but the price is higher, that is rupees 990, than its competitive market, leading to reduced consumer welfare. Then comes price discrimination in monopoly. A monopolistic can engage in price discrimination if they have market power, can segment the market and prevent resale. For instance, Indian Railways may charge different rates for tickets based on the class of service or timing of booking. This actually happens. If you have traveled anywhere, you may have noticed it. Then comes economic effect of monopoly. Monopolies can lead to higher prices, lower output, and inefficiency due to the lack of competitive pressure. However, they may also lead to innovation due to large scale investment in research and development. Then comes monopolistic competition. So example could be, I think the number is little different here, but I will correct it. Example could be fast food chain such as McD, McDonald's, and Domino's offering differentiated products in a competitive market. So here are the features of monopolistic competition. First, there are many firms. A large number of firms exist, but each has some degree of market power due to its product differentiation. So there is some product differentiation between two, and since the product are little bit different, both have some market power or market share. Second comes product differentiation. So firms sell products that are similar but not identical, leading to a brand loyalty and some price setting powers. Third feature is free entry and exit. That is, firms can enter and exit the market freely though the products they offer are differentiated. Fourth, non-price competition. So firms compete on factors other than price, such as advertising, product quality, or branding. Then comes price and output determination. So each firm faces a downward slope demand curve due to product differentiation. In the short run, firms can earn super normal profit because they have some product differentiation. But in the long run, the entry of new firms erodes this profit, leading to a normal profit. This means in the initial, since we have product advantage, we can charge higher profit and earn super normal profit, the profit beyond our normal range. But in the long run, since many will see the opportunity and they will enter our market, and we will be slowly eroding the supernormal profit and will be leading to an only the normal profit. Now comes long run equilibrium in monopolistic competition. So we have a table which consists of output, price, total revenue, total cost and profit. So we have three cases of output 10, 15, 20, having total revenue of 1000, 1200 and also 1200, while the profit is 100 rupees, 0 and minus 200, that is loss. So here comes, in the long run the firm produces at a point where it earns zero economic profit, that is normal profit, which in our case is at 15 units of output. Then comes comparison with perfect competition and monopoly. So monopolistic competition allows for more diversity in products and some degree of pricing power, unlike perfect competition. However, unlike a monopoly, firms in monopolistic competition face competition from similar products, limiting their ability to raise prices significantly. Then comes oligopoly. So the example could be Indian automobile industry with major players like Maruti Suzuki and Hyundai competing independently. So there are two types of oligopoly. First, collusive oligopoly. That's firms cooperate with each other, often forming a cartel. Cartel is nothing but a group of people or just like a body to set prices and output, maximizing joint profits. Best example could be telecom sector before Reliance Jio, with major players potentially coordinating on prices. So after the entry of Jio, the market has been disrupted like anything, and the other players are currently price takers. So earlier all were jointly setting up the price, but currently based on the price change of Reliance Jio, every other players are changing their prices of products or services. Then comes non-collusive oligopoly. Here firms compete against each other, but each firm's decision are interdependent, leading to a strategic behavior. Example is soft drink market with intense competition between PepsiCo and Coca-Cola. Here are characteristics of oligopoly. First, few large firms, that is a small number of firms dominate the market, each with significant market power. Then comes interdependence, that is firms must consider the potential reaction of rivals while making decisions about pricing and competition output. So this means that one's decision influence or impact on another player, so they have to consider the impact on all the potential rivals while making some decision. Then comes barriers to entry. Significant barriers prevent new firms about from entering the market. And then comes price rigidity, that is price tend to be sticky because firms are resistant to change price for fearing of triggering a price war. Then comes price and output decisions, that is in a oligopoly firms often avoid price competition to prevent destructive price wars. Instead they focus on non-price competitive competition or engage in tactic collision. Now we have table for price and output in oligopoly. So we have output of 10, 20, 30, 40, price of 100, 80, 60, 40, total revenue of 1000, 1600, 1800, and again 1600. And we have both elastic demand, marginal revenue, and inelastic. Elastic means they will respond to a change in price. Inelastic means they will not be more impacted due to change in the price. So here we have 100, in both the case 60, 20 and negative 20, that is loss. And for inelastic it is 100, 160, 300 and 400. And we have a kinked demand curve which looks like this, where in this model the firm faces a kinked demand curve, leading to a situation where price changes are unlikely because reducing price below the kinked lead to a steep fall in marginal revenue. So below this fall, the marginal revenue will be falling, while increasing prices above this level, that is kinked level, makes the firm lose customer rapidly. So if they increase price from this level, they will lose the customer, and after this level, the you can see a downward movement in the curve. Then comes another extremely sorry. Then comes another market forms. So in addition to the primary market structure, there are other forms of market such as monopsony, that is a market with a single buyer like a large corporation in a small town employing most of the local workforce. So they are could be a influencing company. Example is large food producing companies acting as major buyers of agriculture produce influencing prices. Then comes one more type, duopoly, that is a market with only two sellers, which may lead to intense competition or tactic collusion. The same example we can continue of earlier one, that is Indian soft drink market dominated by two players, that is PepsiCo and the Coca-Cola company. Then comes bilateral monopoly. So as its name says, it's bilateral, but it's a monopoly. That is a market with a single buyer and a single seller, where the price and output are determinant by through negotiation. So they mutually decide the price and supply. So example could be coal supplied to power plants, where Coal India Limited and the power plants are the sole buyer and seller. So one is the only buyer and there is a single seller. Now comes to a quick summary of what we discussed here. First, perfect competition. It's idealized market with many small firms, homogeneous product, and no barrier to entry. Firms with normal profit in the long run. Then we saw monopoly, that is a single firm controls the market, setting higher prices and earning supernormal profits due to barriers to entry. Then we saw monopolistic competition. So here many firms selling differentiated products, leading to some market power but only normal profits in the long run. And we saw one more type, that's oligopoly, where few firms dominate the market, leading to a strategic behavior and price rigidity. Then as usual we have MG extras, where we discuss or we try to analyze the topics discussed today in a more quick and practical manner. So we have two MG extras for today. First, visit local store, compare price and product variety in a perfect competitive market. Example could be a local fruit market with a monopolistic or oligopolistic market. Example could be telecom provider. So we have to compare the pricing, the services of both the market, telecom market and also a fruit market. And second, analyze the local oligopoly. That's examine the pricing strategies of a few large grocery stores in your area and how they respond to each other's prices. So you have to visit 2 or 3 local stores, grocery stores like Minimart or D-Mart or any other mart store, and try to analyze the pricing of different products, 3 or 4 products, how they are responding to each other, and also to the local market or local commodity price. Now comes to the conclusion, where by understanding these markets, it helps us in comprehending how businesses set prices and output. Each structure has unique characteristics influencing firms' behavior, pricing strategy, and overall market outcome. So that's it for the video. Thank you. Stay connected, keep learning, keep growing, and bye bye.